Let's talk about permanent versus temporary accounts. A permanent account is an account that appears on the balance sheet. So these include your asset accounts, which includes both current as well as long-term assets. Your liability accounts, which includes both current as well as long-term liabilities. And shareholders' equity accounts, which are listed by sources. So you have contributed capital as well as retained earnings. Temporary accounts are accounts that change retained earnings permanent account. So these include your income statement accounts. Those have revenues, expenses, gains, and losses in them, as well as any dividends declared. So let's work on an example. On January 1st, BiteSizeQ&A company purchases $1,000 in inventory. On January 21st, BiteSizeQ&A company sells half of the inventory for $1,200. So let's think about what happened on January 1st. Well, they purchased inventory, so inventory went up by $1,000, and paid cash for it, so cash went down by $1,000. The journal entries would be credit cash for cash going down, and debiting inventory for $1,000 for the fact that inventory went up by $1,000. Let's then think about what happened on January 21st. On January 21st, cash went up by $1,200 and the firm can record $1,200 of revenue. They sold half of the inventory, and half of the inventory is going to be $1,000 divided by 2, or $500. So if inventory went down by half, we can record the inventory expense called cost of goods sold. So the journal entries would be debit cash to record the cash going up, and we can record the corresponding revenue by crediting it for $1,200. And we'll credit inventory by $500 and debit the inventory expense called cost of goods sold for $500. So here are our journal entries for both January 1st as well as January 21st. And let's think about the permanent versus the temporary accounts. First, let's think about the permanent accounts. Permanent accounts are accounts that appear on the balance sheet. So we have cash and inventory accounts. Both of them just happen to be current assets. Next, let's think about the temporary accounts. Temporary accounts are accounts that change our retained earnings account. Here we have both revenue and cost of goods sold. Both of them affect our net income, and they will close into our permanent retained earnings account. So these are our temporary accounts right here. What is the difference between permanent versus temporary accounts? Well, remember, permanent accounts contain everything that appear on the balance sheet, whereas temporary accounts contain accounts that change the retained earnings. So now you know all about permanent versus temporary accounts.